Oh
and
yeah.
put the speaker, give a speaker view. You know how to do it on the top right? So you only see whenever
Yeah.
somebody's speaking, as opposed to, that's it.
Okay.
Thanks.
Okay. So I guess everybody's here so we can get started. So Yannick and Will, I know we had a little kind of, I gave you guys a further task to get started on. And so do you want to maybe just refresh me about where you are and where you kind of work? Because I know you guys had a couple other tasks. So maybe just kind of give me an update from there, and then let me know kind of how it's going with the one I most recently gave you.
Yeah. So you're talking about the roll yield. So unfortunately, me and Will didn't have, we weren't really able to coordinate a good time to kind of meet up. So we both kind of worked on it independently. I was able to get a code running, and I put that on the shared drive. So it's the CSV with the roll yields, and then also the Python code. I'm not really sure if I did it right, so I'll kind of like go over what I did quickly.
Mm-hmm.
I took so online it said that roll yield is like change in futures price minus change in spot price, right?
Yeah.
Okay. So I took the P&L, or actually I filtered out all the timestamps. So I think it was like 1600 hours, like was the timestamp for the futures contract. So I did the same thing for all the spot prices.
Mm-hmm.
And then I took the date that the futures contract expired, took the closing price of that date, and then subtracted the date where the futures contract opened up.
Mm-hmm.
So I took the difference of that, subtracted took the P&L and subtracted the difference of those two.
Yeah, and you did that for each contract, right?
Yes.
Yeah, because I think your futures contracts P&L was fine from what I looked at. So really the only thing you need to calculate the roll return is the change in the spot prices.
Mm-hmm.
If you just combine those, you'll get the roll return.
Okay, great.
Yeah.
So it sounds like that went okay. I still think my data for the P&L was different to what you got. So I was thinking this morning that maybe I could go back and recalculate with your data, the P&L, and then kind of just see which makes more sense.
Okay. Yeah, I can redo it too. I might have done it wrong too. I don't know. I have to check. It's possible. So let me check. Let me check again, because I think I found like a more efficient way. Maybe some more efficient ways to kind of do this.
Okay, great.
Okay. How about you, Will? Any luck? There you go.
I didn't get that far in the process. I basically got as far as re-splicing the data. So being able to pull all the spot prices from the start and end. And this weekend, I'm sorry, I didn't get it by today.
That's no problem.
The first week of my new internship. But this weekend, I'm focusing on getting the loop working for checking the difference and then storing all the differences.
Mm-hmm. Okay. And when you say differences, are you talking about, what do you mean?
The roll yield.
Okay. Cool. Yeah, let me know if you have any questions. But
Will, my code is on the shared drive, so if you ever need to reference that too.
Thanks.
Yeah, I don't know if it's right, but it might steer you in the right direction at least.
Yeah, so I've been working on the methodology for the funding portion of the of the of the project. And I went through a few different ways of doing it. And so I think I settled on, I'm going to use the Bitfinex exchange funding data because it seems the most complete. And it's also has the benefit of being peer-to-peer. So the lending rates are from one user to another. And I started with doing hourly Bitcoin lending rates, and then using the like 1+ formula. Basically their daily rates. So you essentially divide them by 24 and then you use the 1+, and you can cumulatively sort of compound them. And I started doing that. And that was my first kind of the opening salvo, I guess. And then I used US dollar funding rates from Ken French. That was kind of my first attempt. And I was looking at it, and obviously the US dollar funding rates are almost zero in like the last, year or so. They're a little higher before that, lower than the Bitcoin rate. But then I got to thinking, and I thought two things. One, what if I just use the US dollar funding rate within the Bitfinex exchange? So all the funding data is kind of self-contained within the exchange, and I don't know if that makes more sense. I think that makes more sense, to be honest, to do that. And the rate's going to be higher. The rate's not going to be zero because it's essentially a margin funding rate. So it's more like, it reflects a little more risk, obviously, than like a risk-free rate sort of thing. So, but I think it makes sense in this context because the investment rate is also essentially a margin funding rate, the Bitcoin investment rate. So I started doing that. And then I also started to, rather than doing hourly cumulative funding, I try to get the longest tenor funding I could. So like 30 days is the longest that has reasonable data that I could look back at. So I pulled 30-day funding for Bitcoin and
For the peer-to-peer.
for the peer-to-peer, and 30-day funding for the US dollar. And that, I think, is the methodology I'm going to use. And I started working on it. I'm still working on it. I almost got it, but not quite. There's a couple nuances that I think I need to take into account. Because, theoretically, I would love to have an exact, 90-day funding or, just that matches the time frame, but I don't. So we're relying a little bit on, like the I don't know, like kind of the efficient market hypothesis. I guess you would say that the 90-day rate should be the equivalent of the 60-day rate, or the 30-day rate rolled 3 months. Right. Like it should be, probably it's not, but it's, that we're kind of relying on that a little bit, and hopefully it doesn't make a huge difference, but that's what we got. Right. I don't really have 90-day rates that go back far enough that they're going to work. So I think that's the methodology that I like to use for the funding. And then I calculated the Bitfinex, not the Bitfinex, the FTX futures and the FTX spot prices. So essentially the cash and carry part, and, making progress, getting there. It's pretty close. Those returns are not that far off. I saw that with some of the volatility in the marketplace, those are the return kind of widened. The last, I'd say two quarterly contracts, because Bitcoin went from like 10,000 to like 50,000 or something like that in one portion. And then it went down to like 30,000 during the other contract. And so you actually do see a little bit of difference, but there is like significant return just from the roll yield, just from the price convergence, because it really does converge within the exchange. You do see convergence, at least with the roll, at least from the roll return perspective. So So it's going well, all good there. Just working on the methodology and trying to kind of finalize it. And then once we do that, we'll see where it goes. I don't know if I want to write up the results right away or if I want to keep moving forward, because I kind of feel like there's a lot more that we can do. I want to look at perpetual futures contracts, for instance, and maybe some other stuff after, because I after looking at this, I'm like, I keep seeing all these jumping off points that we can make. We could do other stuff where we can do this with a bunch of different currencies. We can do like triangular arbitrage. We can do different funding plays where, there just may be like spread differences. We could look at all sorts of stuff. There's just a lot of stuff comes to my head, but those are kind of next steps. So that's kind of where I am right now.
That sounds great, Matthew. Just another follow-up on the question which you raised last week, that what would be the benchmark for crypto traders.
Mhm.
So I connected with a few traders in Singapore, and they are of the opinion that if you are trading in a single cryptocurrency, then they would prefer to use the total market capitalization. So within the trading period, if the total market capitalization grew by say 3%, and your portfolio or your trade generated a return of say X%, so that is how they calculate the alpha. Another methodology when you are trading with a basket of cryptocurrencies is they use a index of some sort. So industry-wide, there is definitely a need of a standardized cryptocurrency index. There is no standard which is well accepted by all the participants as of now. But just last week, I believe Singapore Exchange came up with their iEdge Bitcoin index. I mean, it was already existing, but they are now trying to promote it as the crypto index for Asia region for benchmarking purposes. So one is the iEdge Bitcoin, and another is a dynamic index which basically different exchange provide in terms of what are the say top 10 or top 15 most traded cryptocurrencies, and they cap their contribution percentage say by 20-25%, so that they have a diverse index to look at.
Okay. Yeah, that makes sense. I mean, that makes sense. For this, I think that I still think our strategy, if we're going to turn it into a trading strategy, I think a cash and carry strategy should still be judged more off like a risk-free rate or something like that, I think, because it really is a long short strategy,
Right.
But
I think
all that makes sense. Yeah. I think. Okay.
Sure. Yeah, we can again come around to that when we are actually about to build the strategy of some sort on, or maybe some sort of arbitrage opportunity is there, whatever we are trying to tap. Then accordingly we can benchmark our own strategy performance. It does not need to be tagged to any crypto index like necessarily.
Right. Okay. Well, I mean, that's pretty much all I have for this week. I don't know if you guys have anything else.
Matthew, if you don't mind going over your P&L data one more time, and then I'll use that data into the roll yield.
Okay.
If I get anything that's a bit more.
Yeah, actually, sure. Yeah, so I've kind of broken this up a little bit where I'm sort of working on the exchange, like using FTX, Bitfinex, whatever, that sort of stuff. The futures there and the spot prices there. And then I'm kind of having you guys work on the CME futures stuff. And then at the end of this, and then I'm planning on using the same funding data, I think, for both data sets. And so, at the end of this, we'll have kind of two distinct views, one within the exchanges and one that's in just the US. And so we could probably draw some conclusions from that, because really the main difference is that in the US, the cryptocurrency is regulated under the CFTC, and it's not elsewhere. So, the only futures that exist are on the CME in the US that you have access to, or elsewhere you have like all-in-one exchanges where you can buy and sell spot, buy and sell futures. You have all sorts of crazy derivatives. You got perpetuals. You got all sorts of stuff. Like, these pretty deep. I don't want to call them deep, but like they're vast derivative markets where you can make wild bets. Like, I've seen some cool stuff. You can bet on, you can bet on chess matches. You can bet on like all sorts of stuff on these exchanges. So it's pretty cool. Anyway, so that's kind of, I think, how I'm kind of bifurcating it. And then at the end, I'll smash it together and we'll write like a paper on it, or a slide deck or a paper or something like that.
Yeah, sounds good.
Sounds good.
If we decided to turn this into like a real trading strategy, do you think Lehigh would give us a little bit of like seed money to experiment with this?
That's a good question.
I don't know the answer, Professor.
Well, likely. I mean, I had considered that, Lehigh, hey, Matt, you could stop the recording. That's good enough for now.